Welcome to Animal Spirits with Michael and Ben. I was searching through the Twitter archive. I forget what I was looking for, but I came across a tweet from Eric Balchunas, April 2nd, 2020. So just over a year ago. Here's the tweet. Unreal. Mutual funds have seen $356 billion in outflows in March. It's hard to describe how wild that is, so I'll just let the chart do the talking.
So this is last year at the height of everything.
This is a chart.
I feel like the last year or so has produced more charts with a huge increase up or increase down on the line, where it just looks like something unfathomable based on the trend.
I found one more chart from, I remember how I found this. When I was compiling the movies that I've seen over the last year, I was just going through our show notes, and I came across some of these charts. This one was from March 20th, and it shows the difference between current exposure and average exposure to stocks over the past 5 years. And it breaks it down into discretionary equity holders, so think traditional stock pickers, versus systematic strategies, like whatever, anything that's systematic, anything that's rules-based. And the degrossing, to use the Winnie the Pooh meme, right? We got the selling and then the degrossing. The amount of selling that they did compared to the discretionary was remarkable.
By the way, Winnie the Pooh meme, selling, and then the rich guy version, degrossing.
There it is. I thought of another one over the weekend. It's just a great format. Somebody was talking to me about Top Shot, and they said, I guess there goes the rarity argument. And I said, that triggers like, oh, you mean scarcity? Rarity is what regular people say. Scarcity is what people who know things say.
Scarcity is what promoters say.
Exactly. So anyhow, this is just another wild chart that all of this, I don't want to say all of the selling, a lot of the selling came from systematic strategies.
Also, it looks easy in hindsight to say everyone bought this dip. It was a generational buying opportunity. But obviously at the time, a lot of people weren't. And I guess according to this, maybe it was the pros. So I looked at... But
wait, hold on. Just real quick. One more point I want to make here is that this gets back to your point, Ben, about how the nature of markets might be changing. Corey Hofstein has written a lot about this. We actually highlighted some of the stuff that Corey wrote last year, how the way markets function today just might change the nature of behavior, prices, how we think about things. I'm not saying throw out historical data, but things are different today than they were in, say, 1978.
And regardless of if that's true going forward or not, you think the reaction next time there's a bear market is going to be a little different. Like, are people going to be rushing in to buy a little quicker because they assume, well, spending's coming from the government or the Fed's going to throw another bazooka at this thing or whatever it is? I think it could, at least for the next few bear markets, change the way people think about like buying when there's blood in the streets and maybe getting in a little earlier.
So you think that'll take us through retirement? Because I just want to make sure that I plan this out properly.
But this was... I mean, as much as this term's thrown around, that was a generational buying opportunity. So I looked at the returns last week and I showed you this data. Since 1950, because I wanted to take off some of the depression stuff, because those kind of like this period take everything away. Over a 12-month period, price gains only, I ranked every daily gain over every rolling 12-month period. And from the bottom, this was the best 12-month return we've ever had since 1950. How
long did that take you to do?
Not that long. I had all the data already. I just had to sort it.
Can you imagine life before Excel? Imagine. So again, this goes to like the changing nature of markets. The fact that everybody is able to do something like this, which is obviously so, anybody could do this with a computer. That also changes the nature of the market. Seriously, in the past, how would you have done that by hand? I don't even know what that would look like. Imagine having to.
Yeah, I have daily data going back to like 1928.
Not to brag. Not to brag, Philip Fisher, but your data has nothing on us.
Right, and but you just click a button and you sort it. You're right. In the past, someone would have been writing this out by hand and scribbling it out.
Yeah, it takes 2 seconds. So,
but here's the downside. Okay, so I looked at anything over 50% in a 12-month period is pretty rare. So what's happened in the past? This was an interesting one. 65% of the time, the ensuing 12 months was a negative return.
All right, consolidation.
But yes. That's nice technical analysis term. But over the ensuing 3 years, then it was positive 100% of the time.
There's a phrase for this. It's called resting once higher.
Okay.
So, all right, I was also looking at some stuff yesterday, and was that a generational buying opportunity? Like, in other words, will we never see those levels again? Here's how much we need to fall in each index. I think the S&P needs to fall 45% to get back to those levels. So could happen, right? 45% from here could happen. the NASDAQ 50%, and here's the coup de grace. By the way, somebody emailed me, it's coup de grace. And I know at this point I'm using it improperly. I'm sorry. I will never say the C. I'm a coup de grace guy. The Russell 2000, 60% from here. It would have to fall 60% to see the March 2020 bottom. That might never happen again. Yeah, never say never, but it might not.
But if you were to price the S&P 500 in lumber prices, stocks are actually down over the last year. Did you know that?
Oh, so Ben just showed me the worst. I can't, you can never say the worst tweet of all time, but this is a chart crime and a half. It was showing the S&P 500 priced in the Fed's balance sheet. Is that even a trade that, damn it, I knew I shouldn't have gone short the Fed's balance sheet and long the S&P 500. That was a terrible trade.
Technically, the S&P 500 is sideways since 2008 if priced in the Fed's balance sheet. Which
just a comically bad chart crime. So Morningstar is out with some of their ETF numbers. This is remarkable. In 2020, there was $232 billion of stock inflows into ETFs. Q1 of 2021, $199 billion. Again, $199 billion in inflows in Q1 versus $232 in all of 2020.
So again, this bear market has changed things, and ETFs are only sped up now from what they were in the past.
Truly remarkable.
It's coming faster. Okay, so A16Z had this really good story on active trading, and it's called Buy and Hold No More, the resurgence of active trading. And they make some pretty good points in here. They talk about how we've seen this rise in passive, but they talk about how like this American exceptionalism thing. They did this really cool chart that shows by country, and it shows the average perception of financial risks and benefits by country. And most of them are like the risk and benefit are pretty tightly wound, and the United States is way off on its own, basically saying we're hugely overconfident. But to me, that's not really an argument because I think we've always had this American exceptionalism thing. We've always been overconfident. So I don't think that's anything new. But they say, okay, what is new is all these fintech platforms. And you have this rise of free trading and Wealthfront, and started it with Wealthfront and Betterment, and then Public and Acorn and Titan and
StockTwits,
Common Stock, StockTwits, Robinhood, eToro, all this stuff that came on board. And I think there is something to that it's just the technology has caught up to this low cost thing and come together at the same time. And I think that's really changed. And I do think that they're saying like basically the Gen Z people, active trading is here to stay for them. And I think that there is an argument to be made for that.
I agree. Here's one nit that I'm going to pick. They said, which it was a great post. They said, in short, retail portfolio theory, buy and hold for 30 years, is being replaced by new investing approaches, including bottoms-up communities and zero-cost passive investing. We believe that in the years to come, active strategies will have a place in every retail investor's portfolio. So the only hole that I'm going to poke is I don't think that one is replacing the other. I think they're perfect complements. I don't think that people are going to start day trading in their 401k, nor should they. But if they want to take a piece of their money, exactly like you and I are doing, Ben, in our Robinhood accounts, I'm all for that. And I agree, it's not going away. In fact, it's only just begun. Did you see the chart that I posted last night?
No.
So the Wall Street Journal showed that they have a great chart showing the net U.S. equity purchases by individual investors. And they said on March 26th, individual investors purchased about $772 million of U.S. equities on a net basis, which was a 60% decline from the almost $2 billion reached in just one day on January 29th at the height of the meme craze. So January 29th was when we got GameStop, oh my God, GameStop, AMC, whatever, all of those meme stocks. So it's not surprising that couldn't end. That was unsustainable. I think everybody in real time knew that was unsustainable. So we're in a 60% decline from those levels. However, if you look at this chart, it's still 2x what it was in 2019. So I think a lot of the Johnny-come-latelys got washed out. I think a lot of the people that came later are going to get washed out with the market pulling back, all of these high flyer names. So that's contributing to it. And I think that this number is only going to continue to decline because the weather is getting nice outside. The economy is going to reopen. People are not going to be in front of their screens. But let's just say that 1 in 10 Robinhood traders, 1 in 10 newly active traders stay. That's still an enormous amount of money because retail traders are now 25% of the volume.
I did a post on this because I liked the 816Z post so much. And we throw out this term Robinhood trader so easily, and it makes for good memes and Twitter jokes. But we hear from people all the time when we talk about this and they say, no, you got it wrong. I trade on Robinhood and this is what I do. And so I think we have a pretty good look into that, with it, like the window into this group of people. And so I said, okay, there's actually 4 types of Robinhood traders. So you have your YOLO trader who is on like the TikTok investor thing, and they're saying, I have no idea what I'm doing. You have people who are just dipping their toe in the water and starting to learn. I call this like the student trader. They're trying to figure out what exactly works for them. Then you have like the Reddit trader who actually knows what they're doing. They are sophisticated. They understand options. They understand how this works. They know short squeeze and gammas and all this stuff. And then you have the dabbler which is like you and I pretty much. We have the automated stuff and the 401, and frankly, the 401k is one of the reasons that ETFs are still going to have some challenges for mutual funds in the years ahead, because the 401k system is so big and that mutual funds are just made for that better. And so you have people who, and I think most people funnel down, if you're going to stick with this and eventually make it, most people funnel down to that dabbler like us, where they're going to have 5, 10, 15, 20% of their portfolio in something like this. They're going to be a little more active, or they're going to have some other status investments and stuff that they enjoy. And then the rest of it is going to be more or less automated. And that's why I think, honestly, this rise of active investing for Gen Z is bad for the active management industry. Because
I thought that was a great take.
They're going to say, no, I'm not going to pay an active manager to do this when I can just do it myself. And then the low cost stuff will take care of itself. So I think it's actually a benefit for passive and bad for the active management industry.
I think so too. Phil Huber does this thing, a post that he calls the paper trail, and it's some of the best charts from the month. And I just wanted to talk about a few of them. This is going to be a chart heavy podcast. So as always, we'll link to all of this in the show notes. I don't know, where did this chart come from? Don't know, but it's a chart showing companies broken down into different quintiles. So 5 buckets of companies, and it's bucketed based on their profitability. So high profitability all the way to the right, low profitability all the way to the left. I got that backwards, but high profitability to low profitability. And this is so interesting. Total return from 2011 to 2016, and then total return from 2017 to 2020. And it is a complete flippening. In other words, high profitability stocks did really well from 2011 to 2016. And then the baton was passed almost like linearly to low profitability stocks.
I think this is one of the things that makes it so hard to be an investor with cycles speeding up, is that we always think in the back of our heads that the current cycle is going to last forever.
Right.
And so people see this stuff where, okay, profitability is the factor that matters. And then, okay, now it's low. And then now we've switched again in 2021 where it's going to go back to values. So
let me put it to you this way, Ben. I have a question, and I don't think there's a right answer here, but do you think that you're more likely to have success finding a style of investing? And let's just say that that's value investing, or let's say that that's growth investing, or whatever you land on. And again, nobody should go all in on one thing, but let's just, for the sake of this argument, let's just say that that's what you're doing. Do you think that's easier to stick with the strategy through thick and thin? Because we know that sometimes when it's thin, it's really, really bad for anything. It doesn't have to be just value. Momentum gets crushed. Sometimes growth gets crushed. Or are there investors that can be chameleons, that can change with the cycles? I'm inclined to say that's almost impossible. Somebody that could go from the cyclicals to the growth to the Momo, like you almost have to be a trader at that point.
Yeah, I mean, if you're trying to choose between like growth and value or high quality, low quality, whatever it is, whatever the factors are, you have 3 choices. You could stick with one where you're just going to pick growth tech stocks. You're just going to be value like Buffett. Or the second option is I'm going to try to pick which one is in favor. That's probably the hardest, right? Trying to time these factors. And the third option would be I'm going to be diversified and hold some growth stocks and some value stocks and some quality companies and some momentum, whatever it is. I'm biased here, but that seems like the simplest approach to me is the one that gives you the least amount of regret, basically, right? So if you're going for this regret minimization strategy of, yes, I'm going to own the losers when they're underperforming, but I'm always going to hold the winners to some degree. I think that's the idea. That's where I've fallen, because I think that's the one that gives you the least amount of psychological pain.
I think Jack Bogle said, why search for the needle in the haystack? Just own this haystack. That's pretty good advice.
Yep, I think so.
All right, another chart that he showed. Oh, this is so timely. 36-month correlation between bond yield changes and value versus growth returns. And we'll link to this in the show notes, but the TLDR is good freaking luck. The correlation is all over the place. In other words, sometimes rising rates can be positive for growth, negative for value. Other times it could be backwards. There's just looking at this chart, there is no rhyme or reason to this relationship.
And the funny thing is, all correlations in asset classes look like this eventually.
But yes.
They come in and out of style, and it's never static.
But don't we hear that rising interest rates are better for value because they're lower duration securities versus growth? I mean, that's the story, right? And this chart just says, actually, that maybe is kind of bullshit.
Right. A lot of it probably depends on what the relative valuations are and which one has done better, and just mean reversion. And that's, again, why these cycles are so hard to predict.
Nate Garassi, stat of the day via Wall Street Journal. This is a good one. The S&P 500 hit 4,000 today, after first reaching 3,000 in July 2019. 5 stocks, I'm repeating for emphasis, 5 stocks contributed 44% of this 1,000-point gain.
This is back to your haystack thing, right? But in getting back to the interest rates, so interest rates were up, I think, 80 basis points in the first quarter. And that's like one of the highest quarterly rises in rates in a long time.
Sir, I prefer a percent of a percent.
Oh, sorry. Interest rates were up 5/8, but in the S&P 500 hit 15 new all-time highs in the first quarter. So it's like, yeah, I guess rates probably will matter eventually, but what's the line in the sand? What point do you get there? But this 5 stock thing.
So it's Facebook, Apple, Amazon, Microsoft, Google. This is why I don't feel sorry for active managers that have had a hard time. Like, I don't feel bad for them, but I certainly feel empathy. I mean, it's brutal. This is the thing. If you're not long, you're short. But seriously, if you're not long these names, then effectively you are short them if you're an active manager. And I got to be honest, I'm kind of enjoying them lagging a little bit. Although I think that they're starting to go again.
This is why closet indexing exists, because you could have a situation like this.
By the way, as we type on Monday, or as we speak, Facebook all-time high, Google all-time high, Microsoft all-time high. Holy shit, these things are busting out. Apple and Amazon are still a ways back, but all right. So sorry, it's still gonna be tough because these names are so big. That's what I mean. If you're not short, you're long, and obviously that's like mostly a joke, but it's kind of not in this case. Facebook is up 4%. Google's up 4%, and again, these are massive names.
So I had someone
benchmark.
Come to me say, I wrote my piece on the rise of active and traders and investors for young people. A lot of people said, okay, well, that means that it's going to be easier to pick off the suckers for active managers and take advantage of them. But I don't see how that's the case with active mutual fund managers who have a more long-term approach in terms of they're not day trading and looking for ARB opportunities. I mean, maybe for hedge funds in places like Citadel and Renaissance Technologies that are taking advantage of small relative value changes over very short periods of time. But I don't think the rise of the retail trader and investor makes it easier for someone who's picking a active growth stock mutual fund. I don't see how this makes it easier for them.
That reminds me, by the way, so higher interest rates killing growth, right? That was the narrative. The Qs are pretty close to an all-time high again.
I think sometimes people look for an excuse to sell something and then make a narrative after the fact.
So I've had this paper open in my window, in my tab, probably since February when it was purchased. And I almost never do that. If I've got a window open for more than like 2 days, it's goodbye.
Are you sure? Right? I feel like you're a 30 tab guy on Google.
I'm really not. I usually have 2 windows with about 5 or 6 tabs each.
Okay.
But I don't let things get stale. Like if I haven't gotten to something in 24 hours, I usually delete it. But this one, I was waiting for the right time, and that was yesterday. So the paper is called "The Equity Market Implications of the Retail Investment Boom," and a lot of it was, equations that are way over my head. But here's the TLDR. The demand of Robinhood, they were trying to quantify the impact that Robinhood traders had on the market. And they just focused it on Robinhood, which was $65 billion. That's not to say anything of Schwab, TD, and all the other IBKR and all the other retail Robinhood-like traders. They said the demand of Robinhood traders accounted for 7% of the cross-sectional variation in returns observed during the recovery in Q2. Considering the fact that they hold roughly 0.2% of the aggregate U.S. market capitalization, their contribution is enormous. Here's one more important data point. withdrawing the approximated $65 billion in Robinhood's assets under management from the U.S. equity market would have lowered the aggregate market capitalization in July by roughly $355 billion. So in other words, they hold 0.2% of total market cap, but they move the needle by 1%, according to these calculations, which Archegos eat your heart out. I mean, that's pretty incredible.
I'm not sure I get this here. Why is this the case? Why are they having such a multiplier effect?
I mean, that I can't tell you. There was a lot of equations. I just took their word for it. I can't fact check them.
Okay, so you did put these. This is why I'm kind of dubious to these sometimes with all these equations, because I feel like the correlation causation thing here could be a little too much. I guess it makes sense. So they're saying I understand that they are amplifying the variance of returns. I don't see why it would add to market capitalization.
Well, hang on, Ben.
By that much.
Just open your slide for a sec. I just want to show you this this chart. So this is long. It's 56 pages. Go all the way to the bottom.
This is usually the point where I get one of these and then I go to the I read the introduction and the conclusion, and that's it.
Yeah, I skipped over the formulas, but I did read most of this. Go to page 45. It shows the valuation effects and the repricing based on size. And not surprisingly, the biggest stocks, the Apples and Googles of the world, it had zero impact on. But look at the smallest stocks. Decile 1, decile 2.
Okay, so they're saying it's having a way bigger impact there.
Yeah, so I think I've read somewhere that like they had a 30%, whatever that means, impact on the smaller stocks. They really, really, really moved the needle on smaller stocks, which again, Hertz declared bankruptcy.
Oh yeah.
And then the price went from 2 to 50. I mean, yeah, that's Robinhood.
And then that equity was worth nothing, right? It's gone now, right?
And speaking of, I think GameStop just finally announced a secondary, right? Do you see the news this morning?
Yes, I don't know what took them so long, to be honest. So they're selling more shares.
Oh, wow. The stock is well off the lows. I guess Warren Kitty still likes the stock. It went from, all right, it was down 17% earlier in the day. It's now only down 4%.
Okay. Benjamin Graham, cigar butt level.
So we've spoken about this a few times, Ben. JP Morgan is out with their guide to the markets. So we just made the case that 44% of the return of the S&P 500 came from those 5 stocks.
By the way, who do you think makes this from them? I want someone to step forward and say, I'm part of this every quarter or monthly, because it's honestly one of the better free tools that there is available to investors.
It's fantastic, but I bet they snap their fingers and they just update this in 2 seconds, right? Because they've already got the template done.
Because they have Microsoft Excel.
There you go. Top 10 stocks in the S&P 500 are responsible for 27% of the last 12 months worth of earnings. That's pretty wild. So take out the top 10 stocks. The remaining 490 are trading at 19.6 times forward 12 months estimated earnings. I don't know. Does that seem bubbly to you? I don't think so.
But the top 10 are trading for 30 times.
Right. Well, forget about those. The average is 15.6, but the average has been rising for the last, I don't know, many years.
So those big, huge $1 trillion stocks that have big multiples, which seems to make sense, those are the ones that are making things look more bubbly than they really are. I could buy that. I also think, talking about bear markets being changed going forward, the window of time to get cheap stocks just seems to be shrinking and shrinking. I mean, it went under like the long-term CAPE average for like a month in 2009 or whatever it was.
How low did CAPE get? Did it even get below 25?
This time around, I think it was barely even. It was in the high 20s still. So I think just getting that fat pitch is going to be, I don't think we're going to see it as much going forward.
Two more quick charts from JP Morgan. They have this really neat chart showing international stocks and U.S. stocks, their relative performance. And it usually in the past has gone back and forth. International outperforms U.S., back and forth, back and forth. The U.S. has outperformed for 13 years. It has been a long, long time. And as a result, or maybe, I don't know if this is causal or whatever, but they show the price to earnings discount of international stocks versus the U.S. And going back to 2001, international stocks have been about as cheap as they've ever been based on this metric. Whether or not that materializes into the pendulum swinging the other way,
this is the one you look at. You look at this chart 10 years from now and you say either A, of course it made sense, international stocks outperformed, look at this chart, or B, of course they didn't outperform, they were cheap for a reason.
Right, but here's the setup. The third chart shows global earnings growth. It shows the China, US, EM, Japan, and Europe. and earnings projections for the rest of the world are larger than the US. So the US is projected to grow earnings by 26%, EM 37%, Japan 33%, Europe 33%. And if you look at the percent of cyclical sectors in EM, Japan, and Europe, it's way higher than it is for the US. So one of the reasons why the US has outperformed is because we have so much more technology stocks versus Europe, Japan, EM. So that's been a headwind for them. It could turn into a tailwind if we get this synchronized global growth. So that to me is very much in play.
Right. So cyclicals in the US is 34% and Europe is 55%.
Right.
That makes sense. So that's been a drag on returns in recent years. That could be the springboard going forward.
Exactly.